that if you believe that the $3,250 gold price is going to last, Agnico Eagle is cheaper than it was when it was selling for half today's share price. If you do a net present value calculation on their proved developed producing reserves at today's gold price, Agnico is cheaper than it was 18 months ago at that gold price. If you don't believe the gold price is going to hold, that's a very different circumstance. For the record, I don't believe the gold price is going to hold. I think it's going to go higher.
Gold prices have pulled back since the United States and China announced a 90-day reduction in trade tariffs amid ongoing negotiations. Veteran investor RickRule of Rule Investment Media maintains that his interest in gold isn't tied to short-term price targets. He didn't invest in gold expecting it to hit $3,000. Instead, he bought it out of concern that it could soar to $9,000 or beyond if the US dollar continued to weaken. Rule views volatility as a buying opportunity rather than a threat, emphasizing the long-term value gold provides in an uncertain macroeconomic environment. Recent financial reports from major gold producers support his outlook. Following a strong first quarter for the gold mining sector, several of the world's largest gold companies posted impressive earnings, primarily driven by high gold prices. Agnico Eagle Mines, for example, reported on April 24th that it produced 873,794 ounces of payable gold at an all-in sustaining cost of $1,183 per ounce. The company recorded $815 million in net income, with adjusted net income reaching a record of $770 million. It also generated $594 million in free cash flow, increasing its cash reserves by $212 million to $1.14 billion. According to Rule, the largest and most liquid gold producers such as Franco-Nevada, Wheaton Precious Metals, and Agnico Eagle are typically the first to attract investor attention in a gold bull market. These companies are favored not only for their scale, but also for their financial strength and operational reliability. Franco-Nevada reported $368.4 million in revenue for the quarter, marking a 43% year-over-year increase. The company sold 126,585 gold equivalent ounces. Wheaton Precious Metals also had a strong start to 2025. President and CEO Randy Smallwood highlighted that the company's core assets exceeded production expectations, driving record quarterly revenue, adjusted net earnings, and operating cash flow. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If you're an old guy like me, you think gold is up from $250 in the year 2000 to $3,250. So I guess it's all how you look at it. I've been an investor for a very long time. And I guess because I'm calm, I've lived a very good life. If I paid attention to price quotes every day for the last 50 years, I would have had a stroke in my 30s and died. Instead, I looked at all of this as noise as opposed to music. At least after age 30, I began to invest for the long term. I've made a lot of money. I stayed very calm, and I don't particularly care about price perturbations. I like volatility when I'm on the buy side in particular, because it's a series of frequent sales. The recent moves in gold haven't been of any particular interest to me. I think I said on your show a couple of years ago, I didn't own gold because I thought it might go through 3,000. I bought it because I was afraid it was going to go to 9,000 or 10,000 or 11,000 as a consequence of the deterioration of the US dollar. And I still completely believe that. Gold can move up and down $100 in a couple of days. And to be honest with you, never mind breaking a sweat, I don't even notice. You know, Ivan, bull markets take a predictable pattern. We're in my fourth now. So honestly, I've seen this movie before. What happens is that the commodity always moves first, usually because it's oversold, because people are betting on a paradigm that was true that's no longer true. And we've seen that in the gold market in the last 2 years. I remember being interviewed by you and your readers asking me, will the gold price ever move? I said, you know, Rick, you keep saying the same stuff over and over and over again, and nothing ever happens. Well, now it's happened, right? The gold price has doubled, basically. The next thing that happens in a precious metals bull market is that the rising gold price, the price of gold rises faster than the cost to produce gold. That doesn't happen right away. You'll remember 2023, the price of gold started moving, but the price to produce gold moved up, and so producers' margins didn't move. And so the audiences said, when will the gold stocks move? Well, 13 weeks ago. The biggest and the best gold mining companies move first. That's true for two reasons. Those who produce gold enjoy better margin expansion than those who don't produce gold.
Right.
And when generalist investors come into the space, they look for the biggest, the best, the most liquid companies first. Gold stocks didn't move for a while after the gold price moved for two reasons. The gold price moved initially because of central bank buying, and central banks don't buy gold stocks. That's why one moved and the other. That's pretty simple. They also didn't move, as we said, because the cost to produce gold was going up as fast as the gold price was going up. So margins didn't increase. But every quarter now, we're seeing absolutely blowout quarters. We're seeing companies absolutely bury margin expectations. And so you're starting to see the gold stocks move after the momentum has been established by the biggest and the best, by the Francos, by the Wheatons, by the Agnico Eagles. We've seen, that whole sector up 50, 60, 70% in a year. You start to see valuation discrepancies between the biggest and the best of the rest. One of two things happens. Either, in effect, value arbitrageurs come into the market and say this thing is relatively cheap compared to the big guys, so they allocate some capital there. Or if they don't, the big guys take over the little guys. He who has the lowest cost of capital wins.
Right.
So if you aren't keeping pace and you have a high quality project, if Agnico Eagle is selling at 14 or 15 times EBIT and you're selling at 8 times EBIT, guess what? You become part of Agnico. That's the way the game works. After that happens a couple of times, the high quality developers and the explorers begin to work. Visualize and ask your listeners to visualize a bull market as a circus master's whip. The handle in the front of the whip is the commodity. It moves first. The high quality gold stocks are the next part of the whip. They move next, but they move further. The mid tiers, they're the middle of the whip. They move after the other two. They move further. And then the end of the whip are the penny dreadfuls. They don't move for a while, but when they move further and faster. That's the way it is. We're still in the part of the whip that's the biggest of the best. We just did a boot camp, an investing in gold equities boot camp. Perfectly timed. The commodity has moved. The best of the best is starting to move, but hasn't completed the move. Some of your listeners, those who paid attention to us 3 years ago and bought the big guys, or those who paid attention but didn't buy the big guys, are going to say, "Am I too late? Agnico Eagle has doubled. Have I missed the boat?"
Right.
Well, Agnico's margins have much more than doubled. I would suggest to you that if you believe that the $3,250 gold price is going to last, Agnico Eagle is cheaper than it was when it was selling for half today's share price. If you do a net present value calculation on their proved developed producing reserves at today's gold price, Agnico is cheaper than it was 18 months ago at that gold price. If you don't believe the gold price is going to hold, that's a very different circumstance.
Right.
For the record, I don't believe the gold price is going to hold. I think it's going to go higher.
Global stock markets rallied on Monday following a temporary truce between the United States and China, in which both countries agreed to reduce steep tariffs for at least 90 days. The move helped ease fears of a prolonged trade war between the world's two largest economies, a conflict that had raised concerns about a potential global recession. Under the agreement, the U.S. will lower tariffs on Chinese imports from 145% to 30% for the next 3 months, while China will reduce its tariffs on U.S. goods from 125% to 10%. Additionally, China has agreed to lift export restrictions on key materials, such as rare earth minerals and magnets, which are critical for high-tech manufacturing. Despite the market's optimistic reaction, the agreement does little to resolve the deeper issues that ignited the trade dispute in the first place. These include the persistent U.S. trade deficit with China and U.S. demands for more decisive Chinese action against the illicit fentanyl trade. RickRule of Rule Investment Media commented on the broader market reaction, noting that high liquidity has left investors eager for any excuse to move prices. He emphasized that geopolitical developments, such as tariff announcements or political summits, often generate short-term volatility, but are frequently more about domestic posturing than real policy progress. Rule argues that much of the public spectacle surrounding these events is designed to appeal to domestic audiences, rather than to signal meaningful economic shifts. Let's get back to the interview.
There's a lot of liquidity in the market, and I think investors were looking for an excuse to take it up. The tariff things scared people. Perhaps people were looking for a reason at that point in time to take it down. It seems to me like a lot of sound and fury, very much like the recent so-called summit between Canada and the United States, where they solved all the problems between our two countries in 23 minutes on TV. Deals are made quietly. They're not made grandstanding for domestic audiences. I suspect we have been fencing with the Chinese and they with us for a fairly long time. And a lot of the theater that you have seen was grandstanding for a domestic audience, and Trump grandstanding for a domestic audience. At least I hope that's what happens. Global trade, conducted even semi-intelligently, makes everybody in the world richer. And I would prefer a world where everybody in the world was richer and where everybody in the world was mutually reliant. I like that. idea. I remember hearing when I was in university, which was back in the Paleolithic, that when trade crossed borders, armies didn't. And I would prefer that. I would prefer to fight the Chinese at places like Walmart and Costco. Invest in yourself. Invest in your education. Read. Invest in your reputation, your brand. Invest in yourself. The world is going to become increasingly stratified between those who produce value for others and those who don't. And those who don't produce value are going to be replaced by machines. Invest in yourself and invest your knowledge. The second thing is whether or not you're materialistic, live below your means. Even if you don't want to get rich, understand that my generation voted itself all kinds of cool benefits, but we forgot to pay for it. And your generation's going to have to pay for it. Save and invest, not merely to become rich, but in fact to survive. I talk to young audiences a lot. And when I tell young audiences in the United States that the net present value of entitlement obligations, unfunded entitlement obligations in the US is $100 trillion.
Jeez.
And that the value proposition is that they're going to pay in until they stop, but they aren't going to take out, that they're going to have to rely on themselves, that all the benefits that I've enjoyed aren't there for them. Boy, talk about a deer in the headlights look. But this isn't some grumpy old libertarian telling you this. This is something that if he paid attention or she paid attention, your high school math teacher would have told you. There's a little poem I learned as a kid. It goes like this. When your outgo exceeds your income, your upkeep becomes your downfall.
Oh, geez. That's a
So
good saying.
save and invest. Live below your means.
Oh, that
You're
says
going to need the money.
Volatility has once again highlighted gold's enduring appeal as both a strategic store of wealth and a cyclical opportunity. Even as headline tariff news provides a brief reprieve for risk assets, the most substantial gains in first-tier mining companies and the resilience of bullion prices underscore that this rally is anchored in fundamentals rather than fleeting sentiment. With large cash-rich producers leading the charge, investors are reminded that periodic pullbacks often lay the groundwork for the next leg higher in both metal and equity terms. As bullion's role as a hedge becomes increasingly ingrained in institutional playbooks, how might emerging exploration stage miners position themselves to capture upside when the broader sector regains its stride? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.